and welcome to Stockwatch Live. After issuing its third profit warning in 8 months, ASOS, the online fashion retailer, once lauded as the model of 21st century fashion retailing, is being hampered by operational issues. Joules, which posts full-year results on Tuesday, is smart to be doing everything it can to keep profits up and costs down, because if you get it wrong, someone pays the price. And it's usually staff and shareholders, as ASOS has so dramatically demonstrated. Not so Joules though. The fashion retailer, famous for its colourful raincoats and wellies, has so far stylishly sidestepped the downturn in the UK retail sector, and that looks set to continue. The brand has said it expects underlying pre-tax profits for the full year to come in at the top end of forecasts of between £14.8 and £15.3 million. There's no denying that Joules has taken great strides in cutting costs at the same time as continuing to grow revenue. For the 52 weeks to the 26th of May, group revenue increased by 17% to £218 million. And that's even more impressive when you take into account the fact that revenues from the retail and wholesale divisions came in 23% and 3% higher respectively, despite being impacted by the transition of some UK wholesale accounts to the retail concession model. And that's a move the company says will ultimately provide it with greater future trading flexibility. Broker Panmure Gordon initiated coverage of the stock in May with a buy recommendation, saying, and I quote, "The Joules brand portfolio projects a wholesome country lifestyle that is proving popular across Middle England. It's put a 365p target on the shares, which are currently trading at 261p. The broker commended the company's flexible omni-channel approach and, looking forward, said market share gains and product extensions provide significant opportunities for further growth while the brand is gaining increasing traction in international markets. One such company that is seeing potential profits slip through its fingers is PZ Cussons, which posts full-year results on Tuesday. Despite a resilient performance in Europe and Asia, the personal care and pampering products group has been consistently hampered by a disappointing performance in Nigeria. It said its full-year profit expectations remain in line with guidance though. In April, the company said it is still expected to see adjusted profits for the full year come in around £70 million on the back of weakness in Nigeria, including an estimated £5.5 million hit caused by significant port disruption. Away from Africa, it said its beauty division was performing particularly well. Gon is the group's chief financial officer, and Tuesday's announcement should be a good chance for Cussons to update shareholders on its strategic initiatives. Anglo-Dutch consumer goods group, Unilever, is also struggling. Due to report half-year figures on Thursday, it said it expects full-year underlying sales growth to be in the lower half of its multi-year 3 to 5% range. Underlying first-quarter sales grew 3.1%. For Unilever, though, it's developed markets that are proving tricky, while Southeast Asia and Brazil are performing well, up 5%. On a sectoral basis, beauty and personal care grew 3.1% as declining sales in oral care due to challenging market conditions offset the growth in skincare and deodorants. Home care and foods and refreshment grew 6% and 1.5% respectively. Turnover, meanwhile, fell 1.6% to €12.4 billion. Broker UBS has retained its neutral rating on Unilever but raised its price target from £44 to £48. JP Morgan Cazenove remains underweight but has raised its price target to £47, while Credit Suisse has upgraded its investment rating to outperform and raised its price target to £50. Perhaps the pharmaceutical sector can produce a turnaround story to show there is light at the end of even the darkest of tunnels. GlaxoSmithKline, which posts half-year results on Wednesday, has just announced that a drug it acquired in a controversial $5.1 billion deal last year has seen a significant boost to the drugs group and its share price. Increasingly under fire for not producing as many money-spinning blockbusters as its rivals, Glaxo will have quietened the doubters for now, with news that the drug has demonstrated its effectiveness in stopping the spread of ovarian cancer when taken as the first treatment after a patient has undergone chemotherapy. When the deal was first announced back in December, such was the scepticism that Glaxo shares fell more than 7%, wiping about £5 billion from its market value. Some analysts had even suggested that it might struggle against another ovarian cancer drug being jointly developed and commercialised by AstraZeneca and Merck. Speaking of AstraZeneca, it posts half-year results too on Thursday. Bad timing then that the US Food and Drug Administration has just decided against approving the company's application for its diabetes drug, especially after it has recently been approved in Europe and Japan. No doubt shareholders will want to know what the next steps are there, as well as what the pharmaceuticals giant plans to do to counteract the effects of the slowdown in China, the world's second largest drug market. Up until now, branded drugs with expired patents have sold well in China nonetheless, because patients have been wary of generic versions made by Chinese companies. But with the government there taking steps to cut prices, AstraZeneca, which generated $3.8 billion of sales in China last year, can't expect to take a hit to lower-cost generic brands, as confidence in generic drugs will inevitably grow as Chinese companies are forced to pass tests proving their drugs match the quality of branded versions. The shares are currently trading around the £63 mark. Deutsche Bank recently reaffirmed its buy investment rating on the stock and raised its price target to £69. Also, keep an eye out for half-year results from ITV on Wednesday, a trading update from the Daily Mail on Thursday, and half-year results from UK property portal Rightmove on Friday. For coverage of all these companies and more as they report in the week ahead, go to the Markets and Insights section at fidelity.co.uk. See you next time.